Welcome. First, we'll set the stage. You're 49, targeting retirement at 60, with roughly $600,000 saved and $100,000 annual income. Over the next 11 years, we need a precise, tax-smart plan that balances growth, risk, and healthcare. In this video, we'll define your target number, prioritize tax shelters over low-interest debt, simplify your portfolio for growth, and plan explicitly for the 60 to 65 healthcare gap. Let's begin. Next, here's our roadmap. We'll begin with the target number using the 4% rule. Then we'll compare tax-advantaged investing to early mortgage payoff. After that, we'll build a simple growth-oriented portfolio. We'll then address the critical healthcare gap between ages 60 and 65. Finally, we'll outline an 11-year action plan, test your knowledge with a couple of short quizzes, and wrap up with a concise recap. Before we dive in, a brief but important disclaimer. This is educational content, not financial, tax, or legal advice. Markets involve risk and returns are not guaranteed. Contribution limits, tax rules, and healthcare regulations change, so verify current year IRS limits and consult a licensed professional to tailor decisions to your situation. Now let's define your target. Begin with projected annual retirement spending excluding any mortgage payment you will have eliminated by retirement. Include lifestyle elements like travel and add a 10 to 15% contingency. Then apply the 4% rule as a planning heuristic. Multiply that spending by 25 to estimate the needed portfolio size. For example, $70,000 in annual spending implies roughly $1.75 million. Recognize this is a guideline, not a guarantee. Taxes, sequence risk, and actual market returns can require adjustment. Therefore, consider a band such as 22 to 28 times spending. Finally, explicitly budget a separate healthcare gap fund for ages 60 to 65 to cover premiums and out-of-pocket costs before Medicare. Moving forward, here's the big picture timeline. From ages 49 to 60, you're in an accumulation sprint. Maximize tax-advantaged accounts, invest for growth, rebalance annually, and build a dedicated healthcare gap fund. From 60 to 65, you enter retirement phase 1, securing coverage via the ACA marketplace or CA-BRA, using HSA withdrawals for qualified medical costs, and managing your modified adjusted gross income to retain subsidies. From 65 onward, Medicare begins and you coordinate withdrawals across taxable, tax-deferred, and Roth accounts to reduce taxes and sequence risk. Next, let's discuss why tax shields often beat early mortgage payoff at a 4% interest rate. Historically, diversified equities have outpaced that cost, making extra principal payments a lower expected return use of cash. Therefore, redirect extra principal toward tax-advantaged accounts. Contribute to your 401k at least up to the employer match, then maximize the 401k, including catch-up contributions starting at age 50. Fund an HSA if eligible, given its triple tax advantage, then consider IRA or Roth IRA contributions, and finally invest in taxable brokerage. There are exceptions, such as variable rate or high-interest debt, low risk tolerance, or a personal goal of being debt-free by retirement, but in most cases the higher expected return and tax benefits are compelling. Now, let's compare extra mortgage payments with tax-advantaged investing. Extra principal payments produce a guaranteed 4% return equivalent and can provide emotional peace of mind. But they reduce liquidity because equity is tied up in the home and can leave you with smaller tax-advantaged balances later. In contrast, prioritizing tax-advantaged investing can yield higher expected returns, meaningful tax deferral or avoidance, and better liquidity. Over 11 years, that flexibility and compounding inside tax shelters can materially improve retirement readiness. Before we go further, remember to verify current IRS contribution limits each year. The 401k has an employee deferral limit, with an additional catch-up allowed at age 50 and above. Traditional and Roth IRAs have their own limits and catch-ups, subject to income and plan participation rules. HSAs have separate limits for individual or family coverage, with a $1,000 catch-up beginning at age 55. Always confirm the current year figures and eligibility before making contributions. Shifting gears, let's simplify the portfolio for growth. Given the 11-year horizon, maintain a growth tilt consistent with your risk tolerance. Use broad, low-cost index funds, a U.S. large-cap index, a total international fund, and optionally some small or mid-cap exposure. In many cases, a total U.S. stock market fund will approximate blends of growth and value funds with fewer moving parts and lower overlap. As you approach retirement, you can add a modest bond sleeve if necessary and rebalance annually or when allocation thresholds are breached. To visualize a straightforward allocation, this pie highlights a sample equity mix: 60% U.S. total market, 30% international total market, and a 10% small or mid-cap tilt. Depending on risk tolerance and proximity to the retirement date, you can overlay a 10 to 20% bond allocation to reduce volatility and sequence risk as you near withdrawals. Now here is an actionable sequence. First, compute your target number with a 10 to 15% buffer. Second, cease extra mortgage principal payments and redirect funds to tax-advantaged accounts. Third, maximize the 401k, including catch-up contributions once you reach age 50. Then fund the HSA, followed by IRA or Roth. And finally, taxable brokerage. Fourth, automate contributions and conduct quarterly check-ins with annual rebalancing. Fifth, establish a dedicated healthcare fund for ages 60 to 65 and price ACA or COBRA options. Sixth, optimize taxes via asset location and, where appropriate, tax loss harvesting. Seventh, plan for potential Roth conversions in early retirement to manage future required minimum distributions and to keep income low for ACA subsidies. Eighth, annually stress test the plan using conservative return assumptions and potential spending shocks. To operationalize the plan, this flowchart routes each paycheck. Cover essential expenses first. Then, check whether you have captured the employer match. If not, prioritize contributions until the match is met. After that, continue to maximize the 401k, then fund the HSA, followed by IRA or Roth contributions. Move excess to taxable brokerage. If any high-interest debt exists above roughly 6 to 7%, prioritize paying that down before adding to brokerage. Note that extra mortgage principal at about 4% is paused in favor of tax-advantaged investing. Let's address the healthcare gap. Begin by pricing ACA marketplace plans and COBRA well in advance, including premiums, deductibles, and out-of-pocket maximums. In early retirement, manage your modified adjusted gross income to preserve subsidies when eligible. For HSAs, contribute aggressively while working. You can either save receipts and reimburse later for tax-free withdrawals, or pay current costs out of pocket to allow the HSA to compound. Maintain a dedicated brokerage bucket for the age 60 to 65 window, and review options every year because plan details and costs evolve. Before our scenarios, here are the working assumptions. Age 49, 11 years to retirement, $600,000 invested presently, and a 7% nominal planning return. Under these assumptions, the future value of the current balance at retirement would be approximately $1.262 million. We will use this to estimate additional annual savings required for different spending targets. Now let's translate spending into required savings. At $60,000 in annual spending, the target is $1.5 million. The gap from the projected $1.262 million is about $238,000, requiring roughly $15,000 in annual savings. At $75,000 in spending, the target is $1.875 million. The gap is approximately $613,000, equating to around $39,000 per year. At $90,000 in spending, the target is $2.25 million. The gap of roughly $988,000 would require about $63,000 per year. These are approximate and assume 7% returns and end-of-year contributions. Actual results will vary. Use them as directional planning figures and stress test annually. Quick knowledge check. Using the 4% rule of thumb, what multiple of annual retirement spending estimates the target portfolio size? Option A, 15 times. Option B, 20 times. Option C, 25 times. Option D, 33 times. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 25 times. This aligns with a 4% initial withdrawal rate, where spending multiplied by 25 approximates the required portfolio. For example, $70,000 times 25 equals $1.75 million. Second question. With a fixed 4% mortgage and an 11-year horizon, which move is generally recommended in this strategy? Option A, keep sending extra principal to the mortgage. Option B, Pause extra principal and maximize tax-advantaged investing. Option C, always refinance the mortgage. Option D, withdraw from the HSA to invest more in stocks. You may pause the video now to consider. We will discuss the answer in the next section of the video. The correct choice is to pause extra principal payments and maximize tax-advantaged investing. This typically offers higher expected returns and significant tax benefits over 11 years, though exceptions apply for high-rate or variable debts and personal risk preferences. To recap, begin with spending to compute your target number. Pause extra mortgage principal at approximately 4% and prioritize tax-advantaged investing. Maintain a simple, low-cost, growth-oriented portfolio. Build a dedicated healthcare funding plan for ages 60 to 65. Finally, automate contributions, rebalance annually, stress test regularly, and verify current IRS limits each year. As we wrap up, calculate your target number and quantify the gap today. Automate additional savings into tax-advantaged accounts. Obtain healthcare gap quotes and begin funding a dedicated account. Simplify your portfolio and define a clear rebalance rule. Then, review and adjust annually. If this helped, please like, share, and subscribe. And tell us in the comments what part of your plan you're tackling first or what you want us to model next. Thanks for watching. If this sprint plan helped clarify your path to retiring at 60, please like the video, share it with a friend, and subscribe for more practical walkthroughs. Share your target number and your biggest question in the comments so we can support you and consider it for a future episode.